All right, welcome everyone. Today we're going to be talking about the history of bear markets part 2, and today we're going to be mostly focusing on patterns and setups to trade during bear markets. So keep in mind you can check out part 1. I really enjoyed it. I'm kind of a history buff, so we really got into the history of bear markets and had a great takeaway in that video, like an ironclad rule you should know. So check out part 1, and if you happen to stumble across this video randomly, be sure to subscribe, like, and ring that bell. That way you get notified as soon as we drop a new video. Doing a lot of these multi-part videos lately. We do a lot of live videos. I want you to be notified as soon as they drop. Okay, so I'm gonna pick up where I left off. So if I talk about anything that might be a little confusing, again, remember part 1, I think it was about a 10-minute video. We really got into the mechanics and why we want to focus during bear markets. Okay, so let's talk about how to trade in one, okay? The key is trade, okay? And when we say trade, that means we're either day trading, which is in and out the same day or in under a 24-hour period, or swing trading over multiple days, okay? Why is that so important? Why do I want you to understand that? Because when we're in the middle of a bear market, those are the times when the market is very fear-driven and very news-driven. So you get a lot of the news overnight, okay? Especially, you know, I always just kind of assume you're operating on the Eastern time zone because the stock market operates on the Eastern time zone. So anyway, Eastern US time zone. So you get kind of that evening news flow, all the evening news shows, all the 24-hour news networks. A lot of the stuff that's bad in the world is happening, you know, in the evening outside of like the day in the US. So a lot of the bad economic stuff, a lot of the bad war stuff, all that kind of news hits overnight. When you've got earnings announcements, when you've got earnings misses, companies tend to announce bad news outside the market hours. So they might announce that news at 4 o'clock at night, 5 o'clock at night, or they might drop it on CNBC at like 7 in the morning, 8 in the morning, because they like to get that news outside of the trading day. So the biggest thing you're going to see is big gap ups, big gap downs, scary moves, where if you stay agile and you trade, you're almost always out of all of your positions at the end of the market day. Or if you are swinging that trade, you follow the ironclad rule of short-term trading. And write this down, winners hold winners, losers hold losers, okay? You want to be a winner? You hold your winners. You want to be a loser? You hold losing trades, especially in bear markets. So basically, the only time, and please follow this rule, and that's why I said it's the ironclad rule of particularly bear markets. You only hold winning trades overnight. If you're flat, slightly red, maybe even slightly green, like maybe say you're up 2 cents a share on an $8 stock, you cut it, you go to cash, because it's not worth it to take that overnight risk. Now, let's say you're in some $8 a share stock that ripped to 12. Okay, different scenario. You're sitting on a 50% buffer. The stock closed strong, stayed above Vwap, maybe closed at a 52-week high. You're going to let that thing gap and look for to maximize your gain the next day. Winners hold winners, losers hold losers. Okay, now let's talk about patterns. The biggest patterns we're always going to look for are going back to that position I just talked about, those weak open red to green entries. So that weak open red to green is, again, a stock that is up, but not up too much. The scenario I gave you, it was up 50%. It wasn't up 500%. Okay, we see 500% runners, but you got a nice 20, 30, 40, 50% runner that closes at or around the high of the day and 52-week highs with great volume, which we use when we talk about VPA, volume price analysis. We're looking at the relative volume versus the 60-day average. So if this stock is trading at multiples of the 60-day moving average on the volume VPA, then we look for that as confirmation to hold this stock overnight. But if we're not in it, let's say you missed it because you're doing something else, you're going to look for that stock to hold the highs, go red on the day, and then reclaim the green move, ideally midday, late day. Now, the reason we like that is that's confirmation that the buyers are in control, okay? When you're talking about a stock that's up 20, 30, 40% the day before, you want to make sure you continue to have buyers. The best way to ensure that you're buying and you're joining that momentum to the upside is buying when the stock goes green, because you've got a ton of people that are taking this move and will continue to push it higher. The other pattern we look for, and this is probably the number one intraday pattern is what I call that VWAP hold high at daybreak, okay? A lot of videos on this on the channel. It's my #1 pattern for new traders, but it's also, you know, all the time. Okay, I love this pattern year round, but it is truly the best during bear markets because this gives us what we call that lone survivor, okay? I use a lot of corny analogies, but you know, I talk about the Marcus Luttrell movie, Lone Survivor, and the reason I use that analogy is, especially in bear markets, you've got a ton of runners in the morning, ton of gappers, ton of stocks that run, but a significant majority of them will gap and crap, as we call it, okay? So what's great about the VWAP hold is that's gonna find that one stock, or maybe two, that gapped, held near the high, consolidate around VWAP, and then perk into the afternoon. Now, I have a StocksToTrade specific scan that's built into StocksToTrade. If you join me on the StocksToTrade live webinars, we use it every day. You can click that link below, StocksToTrade Live. We go live 4 times a day, morning, midday, and evenings. I do it, Matt Monaco does it, Rob Booker does it, all different mentors, all different styles, as well as nights and weekends, 100% free. So anyway, that VWAP hold finds that stock that gapped up 10% or more, consolidates at VWAP, and then perks on volume into the afternoon. That gives us the best confirmation that we have that lone survivor that has a high likelihood of spiking into the close and then gapping the next day, which, especially for those of you under the PDT, is the best way to trade. So those are the two patterns. I mean, really, as much as I love my dip and rips, as much as I love my FGDs, as much as I love my first green candles, those are very speculative patterns that we use more when there's market euphoria. We dial things back, we focus on the week open red to greens and the VWAP holds because that gives us better confirmation that we found the right stock to continue the move that day. All right, everyone, be sure to check out part #1 for a breakdown of the terms. Please don't avoid trading in bear markets. This is kind of a spoiler. I said at the beginning, part 1, the first video, I really got in depth on why you need to do the opposite of what the media tells you to do. You need to be dialed in and ready during bear markets. Trading opportunities are incredible. And that being said, check out StocksToTrade live every morning, midday, evening, and weekends, 100% free. Join us, and if you go to that page, keep in mind, join our Telegram channel. We're really growing the Telegram. We do trade alerts, we do trade recaps, we let you know when the next webinar is going live, also 100% free.